This video segment is a small part of what the market guys offer through their educational products and services. If you are interested in any of our trade alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
Well, good evening, everyone. This is AJ Monty, Chief Market Strategist with the Market Guys, and I'd like to welcome each and every one of you, our regular subscribers, and also the brand new guests who are joining us for the first time. This is a picture of our website. It's the front page of our website, and I'm going to start off with some housekeeping notes for you so that you can stay connected and be connected with me and the rest of the Market Guy team. If you are a subscriber to the Market Guys, then you know we post our alerts to the member page, which is allowing you access once you sign in. Look at my cursor on the top right. Once you sign in as a member, the Market Guy alerts are in the member page. So that's one way you can get the alerts. The other way you get your alerts is by me emailing those directly to you. Now, let me explain something to you. The GoToWebinar platform has certain verbiage that we use when we invite people to the web seminar. And the spam filters that are out there, thanks to all the computer programmers, the spam filters are actually getting more efficient at filtering the spam out of your mailbox. So, for instance, if I use the word free, F-R-E-E, or on sale now, or something to that effect, the spam filter picks up the regular words that are usually used in advertising, and then it spins off your email to your spam folder. So if for some reason you didn't get an invitation from me or my partner Bill, or you didn't get the link to this evening's webinar in your email, please make sure you go to your spam folder, find the email from us, and then keep it out of the spam box. So you could release it and allow our emails to reach you. We give you our word. We're not going to sell your email address. We're not going to pound you with sales pitches and anything like that. We just want to be able to communicate with you. So that's number one. Number two, I would encourage each and every one of you who are part of the service to download the WhatsApp Messenger to your phone. Now, here's how I operate. Once I have completed the trade candidate and I'm sending it in the mail, I post it in a message to our subscribers through this messenger service. It is free. It's a free download. And once you have loaded this, now remember, you have to be a member to have access to this, to me actually. Once you, as a member, have loaded this, all you have to do is send me an email with your phone number that you're using for this service. And once I get that email, I automatically add you to the list to alert you when I've mailed you the alert, so that you're not going to miss anything in the market. And believe me, at any time you could remove yourself from that list. So it's not something you get caught up in and you can't get out. If I add you to the list, you can unsubscribe from the list. So it's very, very easy to do. It's free. And I can tell you that you'll be missing out on some really key bits of information along the way, especially when the Federal Reserve starts talking about interest rates. If there's something that's newsworthy, I'll write about it, I'll message you, it'll bring your attention to it, and then you're not missing out on anything that's happening in the market. So that's my housekeeping points. The way I work the format, for those of you who have been on the open house sessions with me, I usually start off with a market overview that picks up from last week's market report. And I'm going to do that for you right now. As you can see, this is the ticker symbol for DIA, the diamonds. And as I zoom in here, you'll see that I've left my lines in place from last week's report. So you can see where I'm forecasting. You'll see my price targets. So again, for the new folks, let me explain to you what these lines mean. This diagonal line right here is what I drew on the chart last Friday, forecasting what I thought the market would do for this week. And you can see already, isn't this amazing? Already, first trading day Monday, what's happening, we closed within pennies of my line. And this, by the way, is very close to what's called a hammer pattern, a long shadow, this vertical line underneath the body of that candle right there. This long shadow tells me that during the day the market came down to this point, but towards the end of the day the buyers pushed it back. So that's actually a bullish sign. So everything is right in line from what I said would happen last week, and I believe that we will continue to move up this week and eventually reach the end of this line, which is my target price, and most likely somewhere very, very close to this blue line, which is the 20-period moving average. So that's what I said on the DIA, the diamonds. Now, if you look at the Russell 2000, same thing applies. I drew my lines. I drew the support level. There we go. We closed very, very close to my forecast. Again, a long shadow under the Russell 2000, which is a more broad-based index, and I think that it will continue to follow up. Now, please remember, my accuracy, my percentage of accuracy is extremely high. It is currently tracking the best percentage of accuracy in the world, and each and every week I continue to prove this to all of you, especially those who are following me week after week. You know that there's a very strong percentage, close to 90% chance, that the market will do exactly what I said it will do here. 90% chance. Now, if for some reason it falls into the 10% category where I'm wrong 10% of the time, at least you have a line underneath here. I'll back up just a little bit. At least you have a level of support that you can use to defend against the downturn in the market. So, in other words, what I'm saying here is if you're betting that we are going to go up this week and you've taken a long position somewhere along the way, you know that if we close below that line, all bets are off. There's something needs to happen. You need to move into risk management mode and get out of those positions because obviously it's not working out the way we said. Again, 90% chance it will, but there's a 10% chance we'll be wrong. So you have to also learn how to use these lines to protect yourself in the event the market moves against you. Now, that's a Russell 2000. So I'm going to leave that on, and you'll be able to see on Friday when I do the weekend market report, you'll again see whether or not this was accurate. And again, I'm putting my money on the side of the bulls this particular week. Now let's look at SPY. That's the spiders. Again, same thing. Said we would start to move up. A long shadow under here tells us that the buyers came in towards the end of the day. Let me show you what the intraday chart looked like. See, here, this one candle, again, especially those who are brand new to candle charting, let's just focus on this one candle. The red candle tells us that the market opened right here at that mark, right there at the top of, at the top of the rectangle. But the red signifies that we closed at a lower price from the opening price. So at the end of the day, we closed lower than the opening price. But follow me here. These shadows tell us that during the course of the day, we went up and we came down to this low, but by the end of the day, we rallied up to this point. So when you get to learn about candle charts and how they can really signal who's in control of the market on that particular day, you can see that the buyers push back towards the end of the day. So now what I'm going to do for you is I'm going to switch to a minute-by-minute chart to show you what the day actually looked like. And here we go. This shadow area is overnight activity. The white is from the opening here, right at 9:30, this line where it changes from gray to white. That's the opening of the market. And this side of that channel, the white channel here, is the close of the market. So remember what I said. We went up during the day. We opened here, right there. We opened here. We went up during the day. We came down during the day. But by the end of the day, the buyers pushed back and eventually getting it off the lows. But look, we still closed lower than where we opened. Going back to that one single day candle, that's what the story is telling us right there in that one candle. So you can see all of that trading activity today that I just described for you in the minute-by-minute chart is given to us at a glance in the shape of one single candle. So you'll have to forgive me. I just got off the lacrosse field. I coached the high school lacrosse team. I'm a head coach here at Lake Brantley. And I'm going to tell you something that I told these boys today. If you really want to play this game here of trading and investing, and you take it seriously, because you should, it's your money. You work hard for your money. You're putting it at risk. If you want to master this game, you have to, absolutely have to, hone in and fine-tune your skills. Now, obviously for a lacrosse player, you're going to have to learn how to run. You're going to have to learn how to shoot. You're going to have to learn how to catch. You're going to have to learn how to hit really hard. Those are skills that you learn on the field. But for you as an investor, you have to learn how to read the charts. You have to learn, what does it mean when volume is dropping, when a stock is going down? What does it mean when the volume is going up, when the stock is going up? Again, these are questions that many people on this call can answer. But if you really want to master this game, you have to really fine-tune your skills with regard to technical analysis and reading the charts. Because, as I tell many of our students, the charts is the technical chart, the candlestick chart, is where you can get all of your answers. So if you are thinking about buying a stock because you heard about it on CNBC, CNN, or BNN, and you want confirmation as to whether or not that's a good idea, listen, go to the charts. If the analyst on there is telling you buy Facebook because that person loves Facebook, or maybe because their bank just invested $1 billion in Facebook and want you to join them, you need to go to the charts and confirm the technical signals to back up that opinion. If you don't do that, you're basically gambling, and we don't want you to gamble. There's no need to do that. Put the odds in your favor, learn how to read the charts, hone your skills, stay connected to the market guys, and you'll be just fine. Now let's look at the Qs. QQQ. This is the NASDAQ market. Now, if you remember, for those of you who watched the alert last week, I forecasted an up week for the Russell 2000, an up week for the spiders, an up week for the diamonds. But in the Qs, I said we would pull back. Isn't that interesting? The NASDAQ market does not always follow the major indices. In fact, a lot of times you'll see the market go opposite to what we see in the Dow. And look at how interesting this is. Remember, last week I said the Qs would start to pull back. And if you look, today we had a lower high and a lower low. Yes, this is a long candle, a long shadow rather, but this long shadow is not at the bottom of a downward trend. It's a shadow, a small body candle at the top of an upward trend. And you could also see that the NASDAQ market has pulled quite a bit away from this moving average. We call that a price divergence. So there is a good chance that the NASDAQ will start to pull back a little bit. In fact, interestingly enough, today's low came right in line with what my price target would be. Look, if you could read that, you could put your magnifying glasses on, and you can see that my price target ends at 122. Let's see if I could get that to come back. 122.58. 122.58 is where that line ends. Now, what's the low for today? Let's see. What is that? The low? 122.57. Isn't that unbelievable? It came within a penny of closing right exactly at where I said we would hit. And remember, this line was drawn last Friday. Here is last Friday's candle, and I said that we would pull back to hit that target. We came within a penny today. Again, this isn't voodoo magic and tea leaves and crystal balls and all that. This is simply learning how to master the art of technical analysis. And again, like I said, the charts will tell you what to do. Now, I'm going to go into one more, which is the VIX, the VIX. And I constantly talk about the VIX. I constantly talk about it. The VIX is not, I repeat, is not a stock. The VIX is a tool that's used to measure the emotional premium, the volatility in the S&P 500. And I said the VIX would initially pull back, which it did today. It's right on track for where I said it would start to go. And then as soon as we get down, I'll zoom in a little bit more so you can see this. As soon as we get down to this level down here, I believe the VIX is going to go up in a dramatic way after it pulls back first. Now you might say, well, AJ, how can you be that specific? Really, how can you be that specific? Well, in order for me to prove my point, I have to take a step back. In fact, I'm going to take another step back and go to a monthly chart. Now this is a 20-year chart of the VIX. And you'll notice that the VIX only goes down so low. It'll go from 10 to 11, maybe 12. And this whole area right here is an area of support. Now I'm not going to draw that line on there because I need to preserve these lines for next week's report. So I'm not going to change anything. I need to reference that on Friday. But you can see here with your own eyes that we are on 20-year lows. Now, again, how do we interpret this? Well, if the VIX is on a 20-year low and it consistently, regularly, very, very reliably bounces off of this support level, and then on top of that, we know that the VIX is inversely related to the S&P, then we can say with great accuracy there's a good chance the market is going to pull back, the S&P that is. Well, remember, if we're expecting the VIX to bounce off of support and go up, and the VIX is inversely related to the S&P, then that means the S&P has a greater chance of pulling back. Now you might think that this conflicts with what I just said about the S&P, because I said I think we'll go a little bit higher. Yes, a little bit higher, which means the VIX is going to go a little bit lower. But when things start to reverse, watch out below. Now, for the option traders, this is extremely good news, because option traders and many, I would say many of the active traders know how to make money on the way down. When the market goes down in a bear market, we could make a lot of money. But the average person, the average investor who goes to an advisor or a stockbroker, the average investor does not know how to make money on the way down. And that's what we teach at the Market Guys, how to make money on the way up, how to make money on the way down, and also how to make money going sideways. Now, I'm going to prep Bill, my partner, on this because he wants to get a snapshot of what I'm about to show you. What I'm going to show you here, hold on, let me get this laid up for you. This, let me center this here for Bill, okay? This is the evidence that we put out that shows the accuracy behind each one of the trade candidates that we put out. Now, I'm going back as far as 2010, which is when we first started the equity oracle. The option oracle goes back a little bit further in time, but I want to show you not just the winners. See, all of these trades that we put out, and let me clarify here that this column represents the date that the alert went out, the stock that we were looking at the time, our opinion or bias, whether it was going to go up or down, that was our opinion, and the closing price on that day that the alert went out. And then we have a column that tracks the 3-month trailing price, which again shows whether or not the stock went in that direction. Now again, we document this so that people can look at both the winners and even the losers. Why would I ever want to show you the losers? Because there's a lot of people out there that want to brag about the stock that they put out that got 3,000% return. But they'll never show you the vast number of losers that they put out to the public. They don't show those. They only show the big winners. We show the winners and the losers. And you can see here that at the end of this particular year, which is 2011, we had an average of 82.2% accuracy. You can see a lot of green, but again, we're very proud to display our red trades, the negatives, so that people know how to manage risk when things go wrong. Remember, I just said when things go wrong, not if. Things will go wrong from time to time. What do we do about that? We teach people how to manage risk during those times when they're wrong so that the loss is minimal. We try to get people to maintain a 1% rule that we use for minimizing the risk. Now in 2012, you'll see a little bit more red. Right there, you see that? You see a little bit more red. A lot of green, a little bit more red. In that year, 2012, that was actually our worst year. In 7 years, that's our worst year, and we still came out over 75%. That was a 77.5% accuracy. Moving forward, I'm not going to dwell on this. I just want to show you, again, the evidence of how accurate we are with regard to picking stocks and forecasting their direction. Here in 2013, we came out with almost 90%. In 2014, we came out with another stellar year of 86.27%. 2015, you can see here, I'm going to point out, these are the days that we put out a trade that was based on a contingency. What does that mean? We were waiting for a signal to take place before actually moving into the market. So here, for instance, on June 26th of that year, we put out a bullish indication on ABX, but we needed to see the green candle on that day before actually taking any positions. We did not get a green candle on that day, therefore there was no trade. So that's what the red no trade signal means. But you can see as I move along, over 80% accuracy there. Last year, very, very happy to report an 88.63% accuracy. And wrapping up, the total average since 2010, ending on the last day of 2016, we had a running average, 84.42%. So you can see why we are currently tracking the best percentage in the world. I invite anyone to be able to keep track of their records and compare with us. Listen, if there's someone that can get a better percentage than 84%, I'm more than happy to entertain a great conversation with that person so that we can share ideas. It's not about how great you are with regard to picking the stock, it's how great you are at managing risk when things go wrong. So if I have a running total of 84%, what does that mean? I'm wrong 16% of the time, and I need to minimize my risk to a 1% loss. So that's our record. Now, going back to the charts, I'm at that point where I'm going to ask you for stock symbols. Now, please, Hendra, you got yours in there right now. Before anyone types any more stock symbols, I see people, hold off for a second. I'd like to ask that if you put in a stock symbol, I will be more than happy to look at the technical signals on that. But please, let me know what your intentions are. Let me know if you have a position in it. So for instance, if you are, like Hendra, looking at NFLX, Netflix, Hendra says, is it hold or sell? Okay, so obviously that means Hendra has a long position. So let me know what your intentions are so that I can at least identify and highlight the risk management points for you on the chart. So let's take a look, starting with Hendra's stock, NFLX, which is Netflix. This is a wildcat of a stock, and you can see here, this is a daily candle chart going back for the past 12 months. Now, let me say that these horizontal lines mean that I had established price targets in the past. I just never removed them. So I'll remove them now so we can get a fresh analysis on this. I'm going to remove all lines. And let me point out some of the things that literally pop off the chart for me right now. These voids, these are price voids that are called gaps, G-A-P-S, gaps. These are generally points in time where news has more or less motivated the market to go up or down. Now, in this case here, there was good news that came out. The stock jumped up. Here is another indication. Last week, the stock gapped up. But notice something about Netflix. This stock does not like to stay very far away from the moving average. Let me show you what I mean by this. I'm going to draw just a vertical line from here to here. Now, if I had any kind of a measuring tool, a device or whatever, I could measure the distance from here to here. So we're going to have to eyeball this. You'll notice that in the past, the stock does not like to go that far away from the moving average. You see that? Even on the downside, it does not like to go that far below or above that moving average. And if it does, like it is right now, there's a good chance that the stock will pull back to the moving average. Again, history has proved this to us over and over. So therefore, if I'm analyzing this stock and I see that it's already starting to pull back, like we're seeing in this series of red candles, I see that there's a gap here, there's a gap down here, there's even a gap here. I'm not saying that Netflix is going to go from 137 all the way down to 100. I'm not saying that. I'm just saying that there's a good chance it's going to pull back to the moving average. And why did I drop the line right there? Well, Hendra, I will tell you, the moving average right now is at 130.45. That's where that blue line ends right there. So even if we get another down day tomorrow, that down day will still result in a closing price still above the moving average. Does everyone follow me on that? I hope you do. Because it is a moving average. So as long as the stock is trading over the moving average, this moving average will continue to be drawn upward towards the price of the stock. Hence the reason why I didn't extend this line all the way down to 130.45. I'm giving the stock and the moving average a chance to meet almost in the middle between the two, but I still think it's going to go lower. So if you're long the stock, I would say there's a good chance it could pull back a little bit. It might even pull back $6. And you know, for someone who's trading Netflix, you might not think that's a lot, but percentage-wise, $6 that's a good percentage. I mean, you're talking at least 5% move lower, and that could wind up causing you to lose some of the profits that you might have. Now, if you're an option trader, you're going to pay very close attention to that as well. So, Hendra, I think that the stock still has a little bit more room to go on the downside. Once it's filled that gap, it could start to move up. But you have to make a determination as to what point will you start to get out. So let me help you with that. Notice again, I'm basing my opinion on what's happened in the past. So let me erase all my lines so that I can point out to you the method of madness that I continue to involve myself in here. Well, again, look at the patterns that happens. When the stock pulls up and away from that moving average, it starts to come down. High percentage of the chance it comes down, but there's a whipsaw effect. Most every time after the stock drops down below that moving average again, it starts going well below. So it starts to stretch below the moving average, and it does a zigzag effect. So what I would say is, if you're long the stock, Hendra, where did you actually buy this? Would you be so inclined to tell me that, or are you keeping that a secret? Let me see if I could point that. If you could point that out to me, I'll help you even further with the stop level. Okay. Oh, good for you. So you bought it at 93, way down here at 93. Now, Hendra, what you need to do is protect yourself with what I would call a trailing stop. So if the moving average is at 130.45, you might put your stop maybe somewhere around 128. or 127. Why? Because for that very same reason, if it starts closing below that moving average, it could very well start to go down below it. And then if you get stopped out and you see, for instance, that the stock is stretched well below the moving average, it's starting to come back towards it, then you have a new entry point where you can get back into that stock and be able to buy more shares now because you preserved your profits, and now you're ready for the next ride higher. So you're in a really good position, not just to protect your position, but to also preserve your buying power so that on the next ride up, you'll be able to parlay that into something much bigger. Now, I took a little bit longer on that question than I usually do. Hopefully that helped everybody. And then as I start to move ahead, then we will be able to go ahead and move forward. Now, David says, why are you not displaying, was that his question? Why are you not displaying profits and losses? Because everybody trades a different number. I'm not trading a fund, David, just so that you know. I'm trading the accuracy of my forecasting, not the performance of my money managing ability. I do not manage money. I teach people how to get strong percentage of accuracy, and then I go from there. So hopefully that helps you out there. Okay, now Roberta says, thinking of starting a new position in MetLife. So that ticker symbol is MET, M-E-T. Let me put that in there. And let's analyze this. Now, to help Roberta out, let me go ahead and move to a weekly chart. I think that's going to help you. This is called 3D charting. I use different time frames to get a better idea what the long-term picture looks like. Now, MetLife was recently within the last year, acquired by Mass Mutual, I think it is. Forgive me if I got that wrong, but they're not solely held by MetLife, and the agents that work for MetLife have now been moved into a bigger company. And so you have to look at the weekly chart to get a big picture of what the chart looks like. Now see, when I switch to a 3-year weekly chart, this is a different picture, isn't it? Now, I do not have a moving average set on this particular chart for the weekly, but you could do that on your own. I know that by looking at the price action on the weekly chart, it's moved quite a bit away from the moving average. If there was a moving average on here, it would probably look something like that. So it's stretched way above that moving average. Now, what I see here, and this is most noticeable, is at the bottom of the chart, you can see that as the stock has been climbing higher, you see this right here, the volume bars have actually been dropping. So the high levels on the volume are successively going lower. Now, I'm going to put a test question out there to the seasoned traders. What does it mean when the price is going up but the volume is going down? What does that mean? Who wants to be the first one? Boom, boom, boom. I know we have a little bit of a delay there in the answering because we have a lag time there. Okay, Jerry says buyers are getting tired. Exactly. That's exactly what that means. Lloyd says buyers are losing interest. Sheldon says buyers are getting weaker. Exactly. You all got it right. Sherry says less motivation on the buy side. Absolutely. Larry, interesting how he translates slightly different, but he's right. When the price is going up and the volume is going down, Larry said that that's bearish, and that's absolutely true. So, again, to help anyone who's thinking about an entry point on this stock, I would say, what's the rush? You know, what's the rush on this one? I would keep it on a watch list, and then when the stock starts to pull back towards that moving average, let me give you a good moving average to put on your weekly chart. Put a 10-week moving average. A 10-week moving average is the same as a 50-day moving average. And some of you might get that as to why we do that. There's 5 days in a trading week. So if you're tracking 10-week moving average, that's the same as a 50-day if you're translating and converting to days. So put a 10-week moving average, and you'll see that when that stock starts bouncing off of that moving average, that might be the best time to get into that long position. So, Roberta, I hope that helped you. And if you have any other questions, just add them to the bottom. Okay, now Ron Burr says ANW. Let me go in there. ANW. And I will be taking questions, not just stock symbols. Okay, just like David put a question in there, you're more than welcome to do that as well. Okay, so ANW. Now, this is a weekly chart. I put it in while I had the weekly chart up so I could show you what we would be looking for in MetLife should it pull back. You see here, the stock went vertical, pulled back, started to bounce. Now, why is that important? Because we see that there's a pattern of that happening. When this stock goes up and stretches far above the moving average, it tends to pull back. Again, that 10-week moving average would look something like that if I had it put on the chart. So now we see a series of green candles, but what's going on here? Volume is dropping. So we see 1, 2, 3, 4, 5 green candles in a row, but we see almost 5 weeks of down volume. Now let's switch to the daily chart so we can get more precise information. This is showing slightly green. There's a gap above the market. We're bouncing off of, again, this moving average area. So if you're thinking, Ron, about getting in at this point, I would say tiptoe in. There's nothing that's telling me to sell it, but the weekly chart told me to be cautious because we saw the volume dropping on the weekly level. You follow? So if you do buy it, let me get rid of my lines here. If you do buy it, you'll need to put your stop somewhere below the 20-period moving average right there. See that? So if you buy it at 1035, I'm sorry, that's 1085, which is where it closed. If you bought it at 1085, you might want to put your stop at 1035. Maybe give yourself a 50-cent risk per share. Again, for those who are brand new to the market, guys, risk per share is the difference from where you buy it to where you're going to sell it on your stop loss. So we're willing to risk 50 cents per share. And when you use the 1% rule for calculating that, the risk per share number is a very important number to plug into that formula. By the way, if you go to the Market Guys website, click on video, you'll go to the video library and it talks more about the 1% rule. Please, please, please make sure you're managing risk. I cannot do that for you. I'm not sitting by your side. You're the only one that could actually manage the risk for your own account. Okay? Promise me you'll do that. Who's going to do that? Thumbs up. Who's going to manage risk? Who's willing to put the thumbs up there? Okay. Let me see if I can get a thumbs up or hands raised or something. Oh, good, good, good. Thank you. I see a couple of you raising your hand there. Good. Okay. Going back to the questions, and let me pull some stocks out. Okay, Lloyd. Okay, here's a good one. Oh, I love ABX. By the way, ABX is Barrick Gold. It's a gold stock. And Lloyd says, I'm short ABX at 1443. Okay. Now, Lloyd, I got some good news and I got some bad news for you. All right? Those lines, here's the bad news. Those lines are my forecast lines. So there is a chance that ABX could go higher, and I'm not giving you that as my opinion. I'm looking at the price and I'm looking at the volume. Let's do this for Lloyd. I'm going to erase all lines so that we're not confused. And again, for our members, we record this. We record this call. So hold me accountable here. This right here is called a role reversal support. Again, in the video library, I have a video that talks about role reversal. A former resistance area here. See, this is where the sellers took over, pushed it down. A former resistance, once broken, turns into support here. This whole support level, again, known as the role reversal, is coinciding precisely with the 20-period moving average. So that's a good, strong support level. Very close to where it is. So Lloyd doesn't want to hear that because he's short it. He's going to lose money on the way up. So Lloyd, what you need to do is go back to the drawing board and calculate what your risk per share is going to be. If you don't have a buy stop in, you have to hold accountable. You have to hold yourself accountable and put somewhere in there the get out point. So let me show you what this looks like. We are bouncing off of this roll reversal line. We did that on Thursday. Now, interestingly enough, we are breaking out today. We closed above this very, very minor resistance area. Let me zoom in. This area right here, see the stock went up and came down. This is a minor resistance area. This is a more significant resistance area. See that? Now, what does it mean? Here's another test question for the seasoned traders. What does it mean when the stock is breaking out of resistance on, here we go, higher volume? What does that tell us? When the buyers are breaking out of resistance on higher volume, what does that tell us? That's a very, very significant signal that's very reliable. Nathan, Larry, Stewart, Diane, Larry, you're all right. And Vincent, you're right as well. It is bullish. When you're breaking out of a resistance area on higher volume, it tells us that the buyers are motivated. Okay, so again, that's not something that Lloyd wants to hear, but Lloyd, listen, I don't want you to lose a lot of money. I'd rather you lose a little bit, get back in the game, and then pick another and better percentage on the trade. Because here's what happens. Now, for the ladies on the call, I'm going to tell you, this is a fact. Women actually do a better job at managing risk than men do. It is a fact. Maybe it's because of our DNA makeup. I don't know. But men have a tendency to roll up their sleeves and pick a fight with the market. It's kind of like, okay, you're going to try to take money from me? Okay, I dare you, and I'm going to double up on my position. I'm going to fight you. Men have a tendency to do that. I'm included. I've done that before. What happens is when you fight the market, when you fight the trend, when you fight volume, you're going to lose. So here's what I think could happen. I think that ABX could actually stretch a little bit further away from this moving average. I think it could really stretch here, hit this resistance, and then as soon as you see the volume start to drop, that's the key. When you see the volume down here starting to drop, that's telling us that the buyers are starting to lose their momentum. When you see that upon a pullback or close to the resistance, that means the new reversal point is starting to form. So Lloyd, that actually might be another point for you to re-enter into the short position, because at that time the price will be stretched far above that moving average. The volume will be in your favor. You'll have a line of defense in that resistance area, and it would probably put you in a better position. Wish I had better news for you, but that's just the way I'm reading it. Not my personal opinion. It's the interpretation of the charts. Okay, Lloyd, thank you. All right, now here we go. Another short trader, AMAT. Is that Applied Materials? I think it is, right? Let me see, AMAT. Applied Materials, yes it is. All right. Now, Sean is shorted at 34 today. Okay, now Sean, let me give you the good and the bad, okay? Number one, this might be one of the cons. I'll give you the pros here in a second. You've basically shorted a stock that's in an upward trend. This is a major upward trend. Here, I'm going to draw a trend line for everyone. So pay attention, those who have never drawn a trend line. I'm going to pick an obvious low pivot point, and I'm going to connect it to another low. And then what I'm going to do is I'm going to try to massage this a bit to come as close as I can to these low points and then project out. All right, now here's what I'm going to do on the upside. I'm simply going to draw a line parallel to my trend line. That's all I'm going to do. That, my friends, is what's called the trading channel. So helping Sean now, Sean, if you've identified a trading channel and you're thinking about shorting it, even if it's in an upward trend, you really want to try to short it while it's at the top of the channel, not in the middle. So that's all the bad news I'm going to give you. Here's the good news. Okay, here's the good news. I'm looking at volume as the stock is going up here. See how it's starting to go up. I'm looking at the volume drop. Again, we just went over that. That is telling us the buyers are running out of steam. So that's good news number one. The second part of the good news story is that here's a doji, here's an inverted hammer, here's a spinning top, and here's a doji. Test question. Here it comes, folks. What do dojis and spinning tops signal? What is that a sign of? Okay. Wow, look at that. Robert, Ken, Diane, Prem, you're all spot on. The dojis and very small body candles known as spinning tops are signs of indecision. This is a very reliable pattern that tells us there's a good chance the price is going to pivot or start to reverse. So again, good news is that the volume is dropping on signs of indecision. Now, here's where I need to caution you. Okay, now again, take some good notes here, because this is where the rubber hits the road here. If you see, now Sean, this is going directly to you. If you see the stock pulling back to the moving average, which is around 33.01, I would recommend you do whatever you have to do to protect your profit. Because if you sold it at 34 and you could buy it back at 33, take the dollar profit and run. Because I don't see this stock going into a major collapse. And it's not, has nothing to do with their product, has nothing to do with their company, it has everything to do with the consistency of the uptrend. So you're kind of like the salmon that's swimming upstream. You've taken a short position in an up market, but fortunately for you, the short-term signals are moving in your favor. But I don't expect that to stay in your favor. So if you start to get greedy and say, okay, it's at 33, but I'm going to try to buy it back at 32, and then it bounces and goes higher, then again, shame on you. Boom, you should have taken your profit. So hopefully that helped you. All right, Jerry, considering a credit put spread. Now, for the equity traders who know nothing about options, bear with me. I'll do my best to translate target for you, or some say target. All right. The good news, all right, here, I'm going to have some fun with all of you. Okay. Let's go, and Jerry, bear with me here. Let's get a read from the audience. How about that? What are some of the signals that you're seeing on this chart that might lead me towards a buy or not to buy or short? What is the chart telling us? Who wants to be first? What's the first thing? Okay, Stuart says there's gap above the market. Yes, and let me highlight that. Actually, let me get rid of all my other lines so that we're not confusing. And I see more signs being typed in there. Roberto, I'll get to yours. You're absolutely right. Okay, now this is a gap. You see this? I'm going to just draw two lines actually to signify or highlight the gap. This is bad news, came into the market before the market opened. Market gap down, bum, 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 3-4 days in a row. They're killing it. They're crushing it. They hate it. Okay? But now, all of a sudden, there's a possibility here that we might go a little bit higher. So we know, and Jerry probably knows this, otherwise he wouldn't have taken a long position. By the way, a credit put spread is a long position for the equity traders. So we see that there is a gap above the market. Gaps fill, F-I-L-L, gaps fill 80% of the time. So there's a good chance the stock will go up on that point. All right, let's get to the signal that Roberta said. The volume is decreasing. Yes, 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 yes. Here we go. The price is going down, but the volume is going down. Remember, volume is the indicator that tells us the motivation behind the buy or the sell side. In this case, the motivation of the sellers is dropping. So that's bullish. Okay, so recap. Gap above the market, bullish. Drop in volume on the way down, bullish. What else? Let's take a look. Who's next? Well, Roberta, you got that one. I covered you on that one. Nathan, you the same thing. Sheldon, same thing. Prem, same thing. Volume drop, buy gap. I see all that. Huh, interesting. No one. Oh, here we go. Here's one. Paul said, oh wait, Diane says that the length of the candles are getting shorter. Yes, absolutely. The length of the candles is getting shorter. See, if the candles are still very long, that tells us the sellers are in force. Now, here's one of the best questions that came up, and that's from David Bragger here. David says, why would you try to catch a falling knife? Well, that is a great question. Now, I am not the one buying it, okay? I'm analyzing it, okay? So that's okay. That's okay, because what's happening here, the option traders can still participate in this without really having to catch a falling knife. The option traders, all they want to do is make sure it doesn't go very much lower. Okay, so what we're doing here is we are not necessarily catching a falling knife. We're taking a longer position based on the signals. Now, one thing, I'm kind of scanning because no one's, okay, Larry said the rubber band. Yes. What does that mean, the rubber band being stretched? The rubber band effect is, again, goes back to what we talked about in Netflix. Remember, when the stock pulls way below that moving average, or you have a wide divergence above the moving average, it will have a tendency to get snapped back. So there is actually a very good chance the stock is going to do that. Okay, so far, all of you collectively have picked up on all the signals that I look for. KV says spinning top. Yes, that is a spinning top. Sign of indecision. I'm still looking. Oh, there it is. Bruce hit it. Bruce Levitt hit it. Stale red light. Yes, absolutely. So what does that mean? 1, 2, 3. There's 4 red candles in a row. Looking back at the history of the stock, when was the last time you saw that many red candles in a row before it snapped back? Well, here, this was a long stretch of red candles, and then we started to have the green before it started to snap back. See that? So we are overdue for a green candle. Now, again, I'm on a recorded line. I'm going to bet that tomorrow you're going to see a green candle. That's what I think is going to happen. And I think that you're going to start to see the price starting to get drawn up. Okay, now I spent a lot of time on that, obviously, but what I think that did for everyone, including you in the decision-making process for finding the signals, I think all of you helped the rest who are looking and trying to learn about these signals. I really think you all did a great job on that, so hats off to you, and thank you for helping me help everyone else. Okay, I have time for maybe 2 more stocks. All of that kind of wiped out, all those comments wiped out my screen that kind of scrolled through. Can you retype for those who didn't get a stock analyzed yet? Oh, Ken. Okay, I'll get Ken. He typed it in like 4 times there. Okay, so Ken, TLT, short a put spread. So again, being short a put spread is bullish. It's a bullish. So TLT is the iShares. This is for the Treasury bond. Now, I've been analyzing this. These were my forecast lines from way back. And for those who were listening to me analyze this last time, these were my fan lines. Let me see if I can pull back and I'll show you what those fan lines look like. These measured the acceleration in the upward trend. And my forecast was that TLT would pull back and start breaking below these fan lines, which they did exactly that. In fact, this was my target for TLT last month. End of that target was 124.51, so we went well below my target. So again, 100% accuracy on that. But in order to help Ken, I'm going to remove these lines, go back to, actually before I go back to the daily chart, let me show you what we see here. We see a level of support right around here. There's a pretty significant level of support drawn from that low. For the engineer types out there like me, don't worry that that's not exactly on or bouncing above that support. The support is a general area. So I could even go so far and say, okay, here's a level of support as well. So we are in or have reached a general area of support for TLT. Now, on a weekly chart, right here, this is called a harami. It's called that translates to be a pregnant candle. I know that sounds crazy, but the Japanese labeled it as such because they labeled it the way they saw it. And that's like a little baby candle inside mama candle here. That is actually a bullish indication. That's bullish. Now, again, this volume is low because it's only Monday, and that's the weekly chart. So don't really pay much attention to the weekly volume because we just started the week. But if I go to the daily chart and leaving those lines in place, this tells me that there are some signs of buyers moving in. Yesterday, very close to a doji. This is known, that's very close to a hammer. Both of those are bullish. Now, the volume is dropped as the price is lower. So it means the sellers have stopped. What you want to see, Ken, and if you're short the put spread, I think you're in really good position because you're short the 118 puts. You're out of the money on both of those. Again, equity traders, forgive me as I translate this for Ken. Ken, I think you're in good position for several reasons. This is a fairly significant green candle that brought the stock or the price of TLT back over that moving average. So we have what's known as the pivot point. I think this, I'll do it a little bit more conservatively. I think that it's very reasonable to say that this is going to start to move up here as it starts or attempts to fill that gap right there. Okay, so I don't know what month you sold. Hopefully it was a February, but no further out than February, or even, you know, I would say don't really go too much further out on this one because this has some volatility. Did you short the February put spread? Let's see. You can answer that, and I think I'll pick it up here in another second. But yeah, something's coming in there. Okay, I didn't see it. But anyway, I think you're in good shape with that. Now, for any other option traders or even equity traders, I know that's a more expensive price per share, but that does look bullish. And it could also be interpreted as a cup here, a cup and handle pattern with ultimately a breakout over that resistance is going to be extremely bullish. So if you get any kind of a move over 123, all bets are off for a short position. You're going extremely long after that because that's also a very reliable pattern. Okay, I'm going to take Michelle's and then we're going to end on this one. Michelle is thinking about going long AMD. Is that Advanced Micro? I'm testing my memory here. Advanced Micro, it is. Okay. Well, Michelle, I wouldn't think too much longer because today we had a bullish engulfing pattern. Here is a roll reversal support level. You got a bullish engulfing pattern, and as the stock has been dropping, the volume has been dropping. So that's telling us the sellers are losing momentum. So if the sellers are slowing down and we see a bullish engulfing pattern here, it means the buyers are starting to step in. Now, if you're going to get long anywhere around $10, I would say a reasonable target for this would just be maybe up to the moving average at around 11. There's a gap up here that I think could fill up there at around 11. And I wouldn't expect much more than that, Michelle, because you see this moving average, how it's starting to bend over? That's telling us that the trend, the short-term trend, is starting to reverse. So if you're going to get long, I would not stay in it in that long position very long because it could very well roll over on you and then put you in a loss position. So I think you got a good opportunity there. Keep your stop in place. Use the 1% rule. And folks, I have not run out of content, nor have I run out of stock symbols from you. I've just run out of time. And I would really, really appreciate for those members to, again, follow my lead on the WhatsApp messenger service. Stay tuned to the Market Guys, track our progress, duplicate our accuracy, and I think this is going to be a very great year in 2017. Thanks, folks, for joining. We'll talk to you next time. Bye-bye.
For almost 3 decades, A.J. Monty has motivated audiences worldwide about creating personal wealth and winning in business. His time-tested risk management strategies focus on ideas that involve a keep it super simple approach, also known as the KISS principle. These concepts have been delivered to people in over 16 countries around the world, reaching audiences in the millions. AJ is a best-selling author of 2 books, The Market Guy's 5 Points for Trading Success and Take Charge of Your Money Now, both of which have been featured on PBS Television, Fox Business News, ABC TV, as well as Sirius Money Radio. As a financial educator and consultant, he has worked with some of the most recognized names in the financial industry. Companies like Bank of America, Charles Schwab, E-Trade Financial, Scotiabank, and TD Ameritrade's Thinkorswim. If you have ever been challenged with having to make a tough decision regarding when to buy or sell a stock, then help is on the way. The Options Oracle and Equity Oracle Alert services are designed to help you make those tough decisions. AJ will not only help you find the best trade candidates, but he will also lay out the exit strategy for each position in an easy-to-understand format that anyone can follow.
Hi, my name is AJ Monty, Chief Market Strategist for the Market Guys. For almost 30 years, I've traded stocks, options, futures, and even currencies. I've traveled the world teaching people just like you how to profit in the market using time-tested strategies that focus on risk management. You see, the secret to making money in the market depends on your ability to limit losses when you're wrong. In other words, if you want to make a lot of money in the market, don't lose a lot of money in the market. Now that may sound funny, but it's true. Most investors are challenged with 2 questions. The first question is, how do you find a good stock? Well, the best way to find the right stock starts with eliminating all of the stocks you would not invest in. This process of elimination is called stock screening. And our services help you overcome the odds so you're putting your money where the money is going. We're simply following the trends. The second question most people ask of me is, when is it time to sell? Well, if you don't have an answer to this question, then you might find yourself in a position where you're holding on to your stocks when things go against you. This is the worst thing you could possibly do because I believe this is no longer a buy and hold market. It has evolved into a buy and protect market. Holding on and hoping for things to get better is not a strategy. In fact, doing this will eventually lead you to a catastrophic loss, and you wouldn't want that. Our trade alert services help answer these 2 questions. Not only will I help you find the right trade candidate, but I'll also show you how to use the charts to manage risk. I don't use the charts to predict the future. I use them to protect the future. The charts tell me when it's time to get out as well as when it's time to get in. And that's what I'd like to teach you as well. We have 2 services, the Equity Oracle and the Options Oracle. The Equity Oracle is an alert service for traders who would like to trade only equities, whereas the Options Oracle is our premier alert service for both equity and option traders. Each alert is laid out in an easy-to-understand format that shows charts depicting entry and exit points. Risk management is our cornerstone of each service, so you don't have to struggle with the decision of when to get out or when a trade goes against you, when should I take my loss. The strategy is to use the KISS principle, keeping it super simple. As a bonus, you'll have access to a live Q&A session as well, each and every month. This is where you can submit a stock symbol, and I will analyze these stocks while we discuss the best trading strategies for each position. And it gets better. In addition to the alert service and the live monthly Q&A sessions, we're also developing a member page that will include instructional videos about how to get the most out of our service. Without question, this is the best trade alert service available on the market, and we look forward to having you as our newest subscriber. Simply click on the link below to subscribe. It's easy. Once again, I'm AJ Monty, Chief Market Strategist for the Market Guys. Thanks for watching.
Enrolling in this service is easy. Simply click on the link below to subscribe, and your weekly alert will be delivered right to your email box. And if you act now, we will include AJ's best-selling book, The Market Guy's 5 Points for Trading Success. This is a first-time offer that will get you on the road to success and keep you there. Remember, if you continue to do what you've always done, things will never change. Positive results will only come after you have taken the first step in the right direction. We look forward to having you as our newest member.